objectives and their functions. NBFCs, non-banking financial companies, are the financial institutions that offer banking services but does not comply with the legal definition of a bank, like it does not hold any bank license. NBFCs involves in the business of lending loans and investments in shares, stocks, debentures and securities and etc. There is a department called Department of Non-Banking Supervision, which is entrusted with the responsibility and supervision of non-banking financial companies in our country by RBI. NBFCs perform similar functions to that of banks, but there are few differences, like NBFCs cannot accept demand deposits. They provide banking operations without a bank license. NBFCs are not required to maintain any reserve ratios such as CRR and SLR. CRR is cash reserve ratio, which is the minimum amount of cash that a bank has to maintain with the RBI, and SLR is the statutory liquidity ratio. It is the minimum amount of liquid cash, gold and securities that a bank has to maintain with themselves before giving any loans to the customers. And NBFCs are not required to maintain any of these ratios, and NBFCs also are allowed to foreign investment up to 100%. There is no restriction on foreign investments in case of NBFCs. Payment and settlement system like banks, and the objectives of NBFCs are provides long-term credit to the construction, infrastructure, commerce and trade companies for massive projects, and it helps in the growth of national income by providing capital to various private companies, and helps in the acceleration of growth of industries, which in turn increases the GDP of the country. And the next is movement of funds. NBFCs are good for the economy as they helps in mobilizing the funds by transferring the savings into investments, which in turn